Time in the market is going to beat timing the market, and that applies for stocks, and that also applies for real estate. You know, if we look at some of the big swings in values of properties over the last 5 to 7 years, though, and then you look at what that looks like over the last 20, 30 years, right?
Welcome back to Pending and Trending. Today we are diving into the world of private lending, real estate debt funds, and passive investing with Loren Wernette, founder and CEO of REI Transactional. Loren, thank you so much for being here with today. I'm so happy to have you on.
I'm super excited to be on. Thanks for having me.
Yeah, well, let's get right in here. You're the founder and CEO of REI Transactional, managing two private real estate debt funds that build generational wealth for accredited investors. Is that right?
Yeah, that is correct. So we actually have one debt fund and one equity fund. But yep, we basically lend money out of our debt fund, and then we build homes in the Raleigh area out of our equity fund.
Excellent. So, how did you get into building the lending business?
So like anybody else in lending, I got into it because I got an agriculture degree from Michigan State University, right? Totally clear path there.
Sure.
No, in all honesty, like, we all start someplace, and I had gone through a career of, I got an agriculture degree. I was a partner in a consulting firm, worked in marketing in Raleigh, and when COVID hit in 2020, I just decided that at that point, I didn't want to work for someone else the rest of my life. I had some student loans I wanted to take care of. And so that pushed me into, I want to be a business owner, and the business that I chose, the vehicle that I chose, was real estate. And so I bought a bunch of rental properties, and I bought those through creative means, primarily finding investors, private money investors that wanted to be in real estate but didn't want to deal with the tenants and deal with the toilets. They didn't have the deal flow, right? And so we built a system on deal flow for finding good deals and finding private investors that we could then pair those together. And so over the course of 3 years, we built a 65 unit portfolio with well, it was actually 65 properties, 85 doors. We got about $6.5 million worth of private money invested into our company. We did 20 flips. We had a wholesale business. And at that time, I also started the lending business as just kind of a side project. Well, as most people realize, as you do something for a long enough period of time, you're going to start figuring out what you like doing and what you don't like doing, and what you're good at and what you're not good at. And what I figured out was, I do not like managing rental units, and I do like structuring deals and finding opportunities and putting those together. And I'm good at raising capital, and I'm also good at communicating with investors and providing good returns for them. And so it lent itself to, I want to be in lending in the next, in 10 years. And so what do I have to do to make that successful? I need to cut all the stuff out of my businesses that is not getting me towards that goal. So I stopped flipping houses. I shut down my wholesale business. I sold my half of the rental portfolio to my business partner, and I focused 100% of my attention on the lending business. And that started out very small. We did like $40,000 worth of profit the first year just with double close funding. And today the debt fund has about $6.5 million worth of equity, LP dollars in it. We did over $8.5 million, or we did 8.3 million, of loans last year. We've done about 5 million of loans this year so far. And we're constantly shifting and adjusting and learning to make our product better, to return good for our investors, and to scale and grow our business.
Wow, that's a lot of information. That's great. Okay. So basically you are, so what does a private real estate debt fund do, right?
Yep.
Explain that.
So when we're talking about a real estate deal, right, there's a couple places that the money could come from to purchase said deal. You could fund it yourself with money out of your own pocket. You could find someone a family member, friend, whatever, that could lend you the money to buy that property. That would be private money. You could go to a bank, and that would be institutional or bank debt. And the middle option between private and bank is hard money. And so hard money is companies like mine that get investors, whether they be private investors or institutional investors, to lend them money or invest in them. And then they take that and they have systems and processes and they invest that out. And so that is exactly what we do. We basically take money from high net worth individuals and we put them into loans that we have with real estate investors, which are developers, builders, flippers, rental owners in the southeast of the United States. And we provide a good product for our borrower and a good return for our investors.
Excellent. So how do you balance the risk of that, right? So you're using your investors' money, and then you need to make sure that it's going to be a win because you want your investors to be happy, and so how do you balance that?
Yeah, so I would make that a little stronger in that we don't just make sure we can't guarantee, but like we do everything in our power to make sure we're making our investors money. Because if I loan my own money and I lose it, it's my money. I'm the only one that has to feel that pain. But if I lose an investor dollar, not only will they feel the pain, I'll feel the pain, but they'll tell everybody they know about how I lost their money. And so from a reputational standpoint, the number one rule of private money investing when you have other people's money is you never lose your investors' money, right? And so how we manage that is through where we lend, what we lend on, and how we lend. And so we focus on markets that we know are growing and appreciating. So we like the Southeast United States. Specifically, we like North Carolina, South Carolina, Georgia. We're starting to look at Virginia and Tennessee, but we're based in North Carolina. So we understand the economics around that. We understand that household formation is going up. There's a lot more people moving into that area. Home appreciation has held fairly steady, even though things have been a bit turbulent over the last 2 years, year and a half with interest rates. And we also understand that as those markets kind of shift and change, the assets that we invest on will shift and change, right? And so when we build houses, we don't build houses that are in the same size and price point as what the large national builders build. We look at what are the entry-level homes, what are the luxury homes, the spaces that the large nationals don't play in, where are the opportunities in those markets? And then thirdly, we look at how we're going to lend. And so if I have a loan, let's say the guy is buying a property for $100,000, right? I don't want to give him 100% of that money because I need him to have skin in the game. And I need to know that if I have to foreclose, you always have to look at the worst case scenario. If I have to foreclose on this house, I'm going to have to sell it at a discount to get it off the books. And I need to make sure that my basis or amount of money I have into the deal is less than what we could actually sell the home for. And so building out our strong underwriting process of looking at the borrower, looking at what the asset value is, not what it will be when it's all done and everything's pretty, right? But what it is worth today. And then also looking at what the exit strategy is for that borrower. It's great for a borrower to have a great deal and, there's good equity in there and there's, you're kind of protected. But if they don't have a clear plan on how they're going to pay you back, now you've got a loan that's just going to extend and extend and with no clear path to get your principal back. And loss of principal, let's say you put a $100,000 loan out at 12% interest, that's $12,000 a year that you can make on that. That's a lot of years of paying interest only before you've recaptured even that base 100,000 principal that you put in. And so looking through all those and then building a process and a system and a team that does things the same way every single time so that it's scalable is the difference between someone that's lending $200,000 out of their IRA and someone that's building a business that can scale.
Absolutely. So where do you find your people? Where do you get your leads from? The people that want to borrow the money from you?
The people we want to borrow. Got it. So where we get our leads, so it has evolved over time. when we first started, I have a strong network in North Carolina through the local real estate groups. And so we got a lot of people through meetings that I would go to, through word of mouth, referrals. Then it turned into referrals from existing customers and from word of mouth, like, hey, this guy needs this. Hey, why don't you talk to him, right? And as we've evolved, we've pushed into more social media. We've pushed into more Google ads. We've engaged with more brokers, and all in a sense to get the word out that we exist, right? Somebody, I remember who it was, said the biggest problem with marketing with your company is that no one knows who you are. And so every day it's how do we let a few more people know that we exist? And because of our loan product, it's not something you're going to need every day. Once we have been introduced to them, it's making sure that we stay top of mind to them by sending them regular emails, by being on social media, by not just blanketing them with offers like, here, you need money, here, you need money, more like offering them value. This is the shifts we see in the market. These are some deals that we've done in the past and how they work. This is a good example of how you could use our money. Here is a deal and how it should be structured. This is things that a private money or a hard money lender would look for if you were trying to get money from them. Trying to add value more times than we are just trying to extract customers out of a market.
Right. So you mentioned that you are looking at going into the Virginia and the Tennessee market. What criteria do you use to determine that, and why are those your next steps?
So the reason we haven't expanded, I guess the first step beyond North Carolina, South Carolina, Georgia at this point is we haven't needed to, right? We've had enough loan demand. We've been able to fill our pipeline. And when we look at why we choose those three states, it had to do with what kind of foreclosure laws they have, what kind of usury rates, and primarily what kind of population growth, property appreciation, and demographics those states had. And so as we look to continue to scale, we have a model built out for every single state in the country on the 7 or 8 different metrics that we look at. And those ones being close geographically make sense. We aren't currently moving to Florida because of some of the challenges that Florida has, including very high closing costs for borrowers. And so we want to make sure that as we expand, we're expanding in a thoughtful and smart way so that we can not only support our business and make loans the right way, but we can provide a product to the borrower that they actually need and make sure that we're providing cost-adjusted returns to our investors that are appealing to them.
Very good. So you're not going into Florida for that reason?
Not currently, no.
Interesting. What are some of the mistakes real estate investors make when trying to leverage private capital?
So the number one mistake that I see people make all the time is they try to take their best case scenario to a borrower, right? To an investor or to a lender. And so, I've got this deal. I'm buying it for $100,000 and I'm going to put $40,000 into it and it's going to be worth $400,000, right? That may be true, but anybody that's been in real estate for any amount of time knows that a $40,000 budget doesn't get you very far. And it's going to quickly turn into $60,000, $70,000. And so do you have the contingencies in place? Do you have the cash in place to handle those change orders on a project? Additionally, just because you think it's going to sell or that there was one comp that sold for $400,000 that was similar, it doesn't mean your house is going to sell for that. There's a lot of factors that go into that. And so thinking about things from an ARV standpoint or after repair value on what's a reasonable price this house could actually sell for, right? $400,000 at the top. There's also a house that sold for $325,000. I think this house will actually sell in the $330,000 to $350,000 range. And do your numbers work in that scenario? And if they don't work in that scenario, do you want to go forward and take that risk on the deal? And a lender isn't going to want to do that, right? They're looking at what is the house actually going to sell for in a reasonable market, and they want to protect their downside risk. Too many new investors only look at the upside potential and not the downside risk. And the more mature I get into real estate, the more and more I focus on what is the worst case scenario and can we live with that based on how we're structuring this.
That's a good tactic. So how can high earners that have a primary career and their focus is completely on what they're doing, however, they want to diversify and not just put their money in, in Wall Street, stocks, financial advisor. How can they get involved? What do you recommend? How can they build their wealth through investing passively?
Sure. So I get this quite a bit, and I got it a lot more when I was in rentals, right? People would come to me and be like, oh, I've got this money and I really want to get some rental properties. And I think the question comes down to, what do you actually want from an investment, right? If you want a bit of a hobby and investment, you want to be very hands-on, rental properties may be the right path. But in what you're describing, I think fits a lot of high earners kind of persona, in that they have a very high stress job or a lot of time is required from it. They usually have a family, wife, kids that they want to spend time with as well. And they want to get into real estate for the cash benefits of it, but not to do the operations. And so there's a couple ways to do that. And it depends on kind of how your cash is sitting and what you're comfortable with. So if I was just going to strictly go and do passive investing, the easiest way to do it is, and probably the lowest return way, is to go and invest in a REIT. So a REIT are these large national groups that they buy houses, they do all kinds of things. You're invested in hard assets like real estate. Basically, it's like buying stocks. You put money in, you get a dividend out. But if you want more hands-on, or if you want a higher return, anytime you look for a higher return, you're either going to have to offset that with more work or more risk, right? And so this is where a lot of people then turn to syndications. And a syndication is essentially a fund. Like, we don't have a syndication, we have funds, right, where we're pooling money together. And a syndication is, this group is buying an apartment complex, or this group is buying one mobile home park. And I need $10 million. And so they will pool a group of accredited investors together and they will buy that. Usually those sit for 3, 5, 7 years. And then there's some liquidation or sales event. And then the investors get paid back. And sometimes there's money that comes throughout the process there. Now, once that investment is made, it's pretty passive, right? You just kind of sit back and wait for it to come. But there is upfront work on vetting those syndications. Do you like that market? Do you like that deal? Do you like that operator? And I think most people, they might overlook, especially when they're new, they overlook the operator and what they do. And by operator, I mean the fund manager. What kind of track record does that fund manager have? Have they provided a return to their investors in the past? How many other funds or syndications have they completed, not just started, right? Have you talked to any of the other investors that are in any of the existing funds? How do they communicate? When I invest my personal money, in passive things, I want a pretty high level of communication. It doesn't mean I want to talk to them on a daily basis, but I want monthly updates on the project. I want financial statements. I want things like that. I don't want to be left in the dark about what's going on. Good, bad, or indifferent, I just want information. And some operators are better at communicating than others. And so really vetting the operator as well as the project is pretty critical. Beyond that, if you want more hands-on, you can take your personal IRA money and do private money investing. That can be in loans. That could be as an equity partner into individual homes that are being built. Really just depends on what type of investor you are, what you're looking for, and how hands-on you want to be.
That's excellent advice. And I like the things that you said about vetting the operators that you work with. What's the single most important piece of information or advice that you would give to our listeners to build their generational long-term wealth?
It's a good question because there's so many different direct places you can take that. and everyone's at a different point in their investing career, right? Someone might have $40,000 and they're trying to move, and somebody might have $4 million. And the advice that I would give to those two people is generally going to be different. Although I will say, and this is an old adage that I didn't come up with, obviously everyone's already heard it before, time in the market is going to beat timing the market, and that applies for stocks, and that also applies for real estate. If we look at some of the big swings in values of properties over the last 5 to 7 years, and then you look at what that looks like over the last 20, 30 years, right? A lot of variability over 5 to 7 years, but as a whole, 20 to 30 years, property values just continue to go up. And so what you see often, specifically in real estate and anything, right? Prices start coming down or things start leveling out, and you see this sell-off because, I got to get it out now so that I can get my money. But with real estate, even if we appreciate 2 to 3%, which is kind of more standard than what we've seen, in 2020, 2021, you're still looking at a significant amount of appreciation over the course of 10, 15 years. And they say that real estate really doubles every 10 to 15 years, depending on where you're at. And so finding assets that you're comfortable with, that you can sit in for a long period of time, and finding operators or ways to operate them that don't require a lot of hand-holding or pain are ways to make sure that you're in the market as long as possible. Because at the end of the day, if your true goal is wealth generation, which is very different than cash flow, right? If your true goal is wealth generation, then you need to be willing to take your money, put it in something, take any profits that come out, put that back in, and do that over and over for decades in order to compound that. Now, an investor that is, I want wealth so that I can have a boat and have a car and all that, that's not wealth generation, right? That is cash flow. They're looking for a lifestyle. They're looking for cash flow. And someone that's primary goal is to pull cash out of a business is never going to get to the level of wealth that someone that's constantly compounding and living below their means and investing their returns back into other things.
Excellent. So if our listeners want to hear more, I understand that you have a podcast and they can subscribe, listen, and you want to tell them, I know it's Brick by Brick Wealth Building Conversations, right? I love the name of that,
Yep.
by the way, Brick by Brick and Wealth Building. I think that's an awesome name you came up with. Do you want to talk a little bit about your podcast and what they could expect?
Sure. Yeah, so I started Brick by Brick a little over a year ago, I think the beginning of 25. And the goal is most people, they are at some level and they want either wealth or business or whatever, and they want to get to another level. Well, when you're starting out, you think you're going to make these big jumps and move up the ladder immediately or build your wealth from ground up really quickly. And you don't. You have to build not only your wealth, but also your business and your knowledge, one little piece at a time. And so we try to have conversations with CEO types, business owners, VCs, experts, anybody that could add knowledge to our listener base about how to generate wealth, how to think about what's going on in the market, the pieces of the business that might be holding them back, to constantly be building mentally brick by brick so that their business can grow brick by brick, so that their wealth can grow brick by brick. And so conversations are usually an hour. It's very free-flowing, kind of informal communication or conversation between me and the guest. And some of them are really good. It just depends on what kind of information the listener is trying to get out of it. And if you go into it thinking I'm looking for only real estate advice, we get a lot of real estate stuff, but I also think that there's a lot of lessons to be learned from other industries that we can pull in. And I don't think of myself as a real estate person, even though I operate in real estate. I think of myself as a business owner that has real estate as the vehicle I've chosen.
Well, I can't wait to listen. Where is it best for our listeners to find you other than your podcast? Should they check out your website, find you on social? Which is best?
Sure. A few things. So social is probably the easiest. So invest with Loren on Instagram, Wernette on Facebook. If you're a borrower looking to borrow money, we have REI Transactional /home is our website. And then if you're an investor looking for a place to put some money, we have reihighyield.com /home. And again, only accredited investors for our fund. But I'm pretty open. If anybody has any questions, probably the quickest way to reach out to me is just hit me up on Facebook or Instagram, and happy to schedule a call and talk through anything or help any way I can.
Excellent. Well, thanks so much for being on today and providing all this information.
Yeah, thank you so much for having me.
What a great conversation with Loren Wernette. Wealth truly is built brick by brick. Whether you're investing in real estate, private debt funds, or simply making consistent decisions over time, long-term wealth is rarely built overnight. Thanks for joining us on Pending and Trending. If this episode was helpful to you, please subscribe and share it with a friend. If this episode was helpful, check out the next episodes of Pending and Trending for more real conversations around building wealth and financial freedom.